Not in the jump seat, your worship. It is a workshop, so I wonder whether or not you're in the jump seat or Philip Jones. Probably.
I'm quite happy to jump out the store. Jumped out a few different side doors on occasion. Yeah, no, I'm fine. Just, yes.
Okay.
Thank you. No, but thank you, Chair.
Kia ora.
We're all good to go.
Kia ora. Welcome everyone. I'd like to welcome Mark and Councillors, Independent Chair Philip Jones and prospective candidate. Welcome. Thank you for coming to attend and all of those online. So the intent of today, I'd also like to introduce Stephen Watson from PricewaterhouseCoopers, who's here, who's been helping the finance team over the last couple of months prepare the financial report that you see in front of you. We've also got a number of staff in here in the room at the moment. Some of you will know that Johannes left us yesterday, so normally we'd give all the hard questions to Johannes. So we've got some of the team here in order to pick up the roading, waters and waste questions if there are any. Firstly, I'd like to pass a big thanks to the finance team, the comms team, and to Jerry Brooking for the report you see in front of you. Those three groups, Jerry, Sarah and the finance team, worked incredibly well together along with PricewaterhouseCoopers to prepare something, have it tested, checked, audited or double checked by us and presented in front of you. I'm very, very happy with the report that we see. And I'm very happy to advise that things haven't been moving for the last 2 weeks, which is also quite comforting when we go through and double check things and find minor typos, but not any kind of errors or adjustments that need to be made. We've got 3 areas from last year's annual report that we focused on. One was road smoothness, one was the community survey, of which there's a report later in the risk and assurance meeting, and the final one is Castle Rock investment. So PricewaterhouseCoopers have been helping us with 2 of those 3 things, being Castle Rock and the community survey, and the team have been working on the road smoothness ourselves. So those are the 3 highlights from last year that to pick up on. But the report you see in front of you has got those measures up. We do have a number of metrics, non-financial reporting metrics that have come through that are, so I think we're about 60% of our metrics have hit the target and about 38% haven't, with a couple that are unable to be measured. We are very close to the target on a number of metrics, so 1 or 2% out. And there is some explanation that we can provide to those should you wish. But, when our target is 100%, it's a very high bar, and 99% sounds very close, but it also is a miss. So we've reported that as a miss in the report. From here, what I might ask Stephen to do, if he's okay, is to give a walkthrough just on the financials, if Stephen's all right to do that. And then we could probably open up to a bit of a Q&A from there, if everyone's okay with that.
Sounds good.
You're okay with that, Stephen?
Yeah,
to join us. And
Everybody, the financials this year, I'm just giving a very brief general look at where things are at. This year, there haven't been any particularly unusual items going through the accounts that we would think would give a cause for alarm for all New Zealand when they're looking at the accounts or anything like that. Most results are actually reasonably much in line with the LTP numbers that we're using as the budget base. So if you're looking at the accounts, you'll see that the surplus for the year was budgeted at 3.5 million and the actual was 4.1 million. So it's relatively close and actually on the positive side of that. Last year was actually break even. So it's a considerably higher result than the previous year. Fundamentally, there's a few little ups and downs, but the main thing that's different in the accounts is that grants and subsidies are up on what was on the LTP numbers. And a lot of that is actually just down to timing as to when things actually get approved. So things like, say, the Better Off funding had been in the pipeline for quite a while and got approved around year end, but wasn't in the budget. So there were a few items like that that basically contributed to that slightly higher result. The main difference in the accounts to the budget is actually in the comprehensive income, which is after the sort of normal profit for the year, which recognises the 3 yearly revaluation of all the assets that the council holds. So every 3 years, pretty much all of the assets, whether they're heritage, infrastructure, buildings, all those sort of things, are revalued. The LTP made an assumption, of a certain level of revaluation. The actual revaluation is a little bit lower than that. But obviously it's based on what market conditions are now. So that goes through what they call other costs of income, so sort of below the line. And that total was about 27 million overall for the year. And that's reflected in the revaluation and also in the assets that we carry at the balance sheet. There's been quite a lot of work done, because that's obviously one of the big areas that New Zealand will look at as well. So they've been independently valued, and we've also had the relevant managers in each area have a good look at those valuations. And PwC did a brief review of it as well, just to make sure that we actually looked like we were coming up with the right sort of numbers. Audit New Zealand have already done their review of those and come up with no major issues that they had any problems with as part of their interim visits earlier on. And in the balance sheet, again, most things are fairly stable. Predicted they'll be at year end. The main difference is just that there's a couple of items that there's a sort of shift between two different accounts in terms of things like cash versus short-term deposits, those sorts of things. So overall, the result is very much in line with where we thought it would end up being, and there's no significant issues that we're aware of that major explanation or anything like that. So that's just a very quick overview of where things are at. I thought we'd probably just open it to any questions, and Scott can have a look through those results, which hopefully I can give you the answers to at this stage.
Not a question, but a comment. The Office of the Auditor General, you won't go on tail, who was a ex-Ernst & Young senior partner. So he comes from, and he has audited local government clients. But what he made in his latest report, whether it's him or the staff, it's not always 100% clear. They commented on last year's annual reports. And one of the generic comments was, and you've already mentioned it, about the subsidies and grants being significantly up. And that was up last year for a lot of councils as well. And it's not a legislative compliance, so it's actually, they are looking for councils to explain where that money was actually spent as part of a general report, or even in the annual report. Now, the problem with the annual report is the likes of the OAG and a certain number of bean counters read it from cover to cover. But I wonder whether that is an issue for this council. I know it's, for the likes of the ones that have had significant cyclone recovery, it's a major issue, but it's just an ongoing issue that if we could get ahead of the game, is that actually possible?
Very, very good question. I think we had cyclone recovery, which would have shown up in transportation, and that work has been completed towards the end of this year. So that's not going to flow through into next year. In addition, there was DIA funding that was referred to as better off funding. So that came through the Three Waters reform. And then towards the later part of the year, when the government changed, there was a final component of some of that waters funding. So that's gone into waters investments. So those really make up the bulk of our grants and subsidies. And I think we have picked up, and I'll look wildly around the room to see whether or not we've picked up our commentary around where we've invested the better off funding. I don't think we've specifically identified the additional funding in transportation, because that was mostly picked up in the prior year, and it's just been a continuation. I know we have picked up some of the better off stuff with the flat point flood resilience.
The bridge design.
The bridge
listed in this.
Some of those things are included in our report, but not specifically as a joined up solution for this is why grants and subsidies went up.
Is it because often what councils can do is they can do a major variance at the end of the document, and I wonder whether that might be an appropriate place to put it, and then it also might go into the summary as well, summarise. Is that appropriate?
We do have a major variance.
It's mentioned, but maybe
it doesn't actually give a table.
A table, yeah. What's your view?
Well, in the interest of transparency, I suppose it makes good sense to put something that gives people a bit of a snapshot of why those things are at.
Yeah.
I don't. I think it's. I'm with Stephen. I think it's a good suggestion to add
Councillors
into the major variance report.
No comments, positive or negative? Oh, Brian.
Thanks, Phil. Whilst I think it is a good idea, are we doing something that perhaps we may be opening ourselves up to more criticism? Would be my thought, whether we generalise over it, or do we have to go into a lot deeper and then open up a can of worms?
So, right, so I've seen a whole lot of commentary in previous years where councils have had all these surpluses, and of course the problem with an accounting surplus, it's an accounting surplus. It's not actually a rate surplus. Big difference. And I think by actually talking about how that, because all that subsidy is sitting in as revenue, some of it would be in capital and other expenditure, which actually doesn't actually form as part of, excuse the old English, the profit and loss, right? So the revenue's there, but the expenditure is in capital or somewhere else. And I think that to me may actually help us explain why we've got a large surplus as well. So that actually is a positive. And it's been money that's been given to us, which is actually a good news story, in my opinion.
Because it does look a bit, if we've got a $4 million surplus, like we're overrating.
Correct.
Absolutely.
Yeah. Right. But we're not, right?
And then overdrawing down debts. You've got savings and you've got debt, and then you rate highly, so it doesn't look good.
I think it's a point that's well raised. I don't mind being opened up and challenged with questions. That just tells me you should front foot it. And front footing is a far better option than being called up. And then in the heat of this debate, you're not able to actually explain the difference between a surplus and a surplus. I mean, most people expect councils to run a zero budget. They expect it to be flat, that the rate and in their heads, surplus means I was overcharged. And if that is not the case, we need to front foot explain that and tell the good news story side of it. So I think it's a point well raised. Thank you, Philip, and team. I think that's a wise adjustment in my view.
Yep. I mean, it is sort of explained, right? This is where you've got this thing called a funding impact statement of the whole of council. So they have actually, that you are required to break it out, the surplus, the subsidies into capital, but it's not clear on page What are we? 102 of the report, or 93 of the agenda, does actually break out the subsidies from grants. You can actually see we were spot on, right?
Yeah.
For capital, but for operations, yes, you're quite right. It's about 7,000, which goes straight. Well, they both go to the bottom line. Yep. Steve, you look puzzled.
Yeah. No, I do have a question. I'm not sure how to frame it, so I'll just start and tell them to shut up. For the first year of the long-term plan, which is what we're reporting on, we reduced we only took 50% of the depreciation rate of that. I would have thought that should show up as either we've spent less money because we didn't have it, we borrowed more money, or that we're taking money out of reserves. I don't see any of that in here. So is that some sort of magic, or invented some money something?
Yeah, I wish. I wish we could invent money to spend on infrastructure.
Yeah.
Two things have occurred, and I think it is the numbers that we see are summary numbers. So perhaps I'll explain. We did reduce the depreciation charge, particularly on our infrastructure spend. That did result in increasing debt, and that increased debt is mostly in the waters space. We also draw down on reserves to do things like Norman Road, which was we drew down on infrastructure. Well, it's going to get them wrong. They are financial contributions. We drew down on financial contributions, which for Norman Road. The reserves that you see are a summary of all of our infrastructure reserves. So 3 waters, drinkable water, stormwater, wastewater, as well as roading, and our parks and reserves reserve. When a developer subdivides the land and pays a financial contribution, they pay a contribution for each of those, and we split it into the relevant pot. Now, we've drawn down on some of those pots, being the potable water one and also the roading one, but we haven't drawn down on some of the other pots, say being wastewater one or the parks one. So they have gone up. So it looks like the overall total of reserves hasn't really dropped as much as we would have liked, but within that, we have drawn down on reserves. We have increased debt as a result, but the overall pot hasn't necessarily changed that much.
Because money was still coming into reserves during the year as well.
Yes. Now that will change more next year as we leverage more on those reserves, and also as we start spending on Carrington Park. So I would expect that all of our infrastructure reserves and the parks reserve would also drop next year. So we could well see an increase in debt and a drop in reserves next year. But it's a very, very good question, because it looks like nothing's changed and we were magic, and I wish that was true.
Can I just help there, Jeff? Actually, if you look on that funding impact statement, you look at the bottom of it, you'll actually say, and this is, I don't want to use the word balancing figure, but sometimes it can be, right? You've got a balance, down the bottom, you've got an increase or decrease in reserves on that page. So you can actually see that we have actually drawn down on our reserves.
There is a note. I can't recall which note there is, but there is a note that explains the reserves, and you will see within that a couple of those infrastructure reserves have a very low balance. I can't recall which note it is. Is there a note on there?
It's not, but I know where it is. It's at the bottom back of the.
I'll read it. There's a note for special reserves.
There is, yeah. It's right. Normally, it's at the back of
The whole document.
It's towards the end of the annual report from memory. It's where I can't remember exactly where it is here.
Yeah, funding impact report, page 77. Decreasing reserves 2.4 million.
There's a detailed under note 14.
Page
14.
Page 69, I think, or 136, 137 of the copy paper.
Yeah, there we go.
Yes.
Equity reserves.
Doesn't actually say that specific reserves though, does it? But there's, I thought I had a revaluation. Revaluation reserves, they're not.
Asset revaluation reserves, yeah.
That's funny money.
It should be special reserves.
Yes, there is. Yeah, I did.
That's funny.
Is it
That's when
special funds reserves?
Yes.
It's on page 148.
you say that's, when you say that's funny money, like that'd be the helpful thing for us to know. When
Oh,
we get these,
that-
don't
oh.
ignore that it's funny money.
Okay, so, oh, if I can play the accountant here.
Yeah.
So when you revalue an asset, say you've got, and I'll make it easy, you've got an asset, a road, and it's worth $100, and it gets revalued, and it might be now worth $120. That $20 isn't cash.
Mm.
So basically what happens is you increase the value of the asset. Your asset goes up by $20 in your plant, property, and equipment line.
Yeah.
And then the $20 goes into a revaluation. So it's a reserve, but it's an accounting adjustment.
Yeah.
So there's no cash associated.
But then you'd have to depreciate to the new value.
Correct.
So you're screwed sort of twice in that situation.
This-
You're paying for something that's
You're exactly right. That's
On
the
paper.
government funding model.
Yep.
That's it.
Yeah.
So
And-
future
and-
years, you've got a much bigger charge.
yeah.
And can I defend the bean counters on this one? Right. But if your road value is worth enough $20,
Mm.
and yes, you don't actually have to fund depreciation. You might have a balanced budget, which includes it's complicated. So I'm going to that now. Otherwise, we'll be here for an hour and a half. But what you will see is if your asset has gone up by $20, the cost to replace that asset also has gone up by $20.
Mm.
So let's talk about your reseals. That's an issue in the annual report. That when your cost to reseal, that reseal is an asset because you do it every. How often do you reseal? Every 10 to 14 years? Right?
I think it's about every 30, isn't it?
Depending on the road. That's the rehabilitation. Anyway. But in theory, we're talking theory here. So again, the assets of that top coat, the reseal would go up by $20. And then every year, the cost to reseal would have actually gone up by 20% because your asset's gone up by 20%.
The intent of the funded depreciation through rates is to pre-fund capital works.
Mm.
And the reason they include the revaluation is supposedly future capital works are now more expensive because the cost of the asset is more expensive to replace. What we seen, so that's a pre-funded model.
Yeah.
We draw rates in through depreciation and pre-fund capital, and then spend all of that capital on that asset. And over time, those two are meant to equal. And we know for various reasons they don't. The Waters model moves away from that pre-funded depreciation model and moves to a post-funded debt model. Which is a completely different model. But unfortunately, under the Local Government Act, we've got to pre-fund depreciation, including revalued depreciation through rates. So it's not exactly the world's
No, not great.
best model.
With just regards to the road thing you've just mentioned, I read in the report about road width versus length and distance. Can you talk about that a little bit? And is there a way that can be reflected in future reports that because of where we are and type of roads we have that impacts the kilometres that are getting covered each year?
Yep.
Absolutely. I think Councillor Della pointed out that in some cases we're doing really well. Whilst we reported that we graded 750 metres of road, we actually graded 750 kilometres of road, which is quite a material difference. So I'd like to say thank you to Graham for doing that in the last day of the financial year.
Really?
But so yeah, we are hitting the metric on but the resealing one does tend to be the one that is most flexible. So I'm more than happy to expand our metrics in terms of what we're doing and how we report on those. But width, kilometres, probably square metres. Square metres might be a more appropriate. As we spoke about in the speed review, Park Road is quite narrow compared to Moreton Road, and we consider them both the same road. But when Graham and the roading team resealing one versus the other, there's quite a difference in cost because of width.
Yeah.
Good idea. If I could go back to your question, Councillor Lawrence. Thank you, Stephen. Page 149 on the hard copy, actually, the statement of special fund reserves.
Yeah.
And so you'll see down there, 3 from the bottom, infrastructure contributions fund, and that's where we collect financial contributions from developers, and that includes waters, our 3 waters and roading. And you'll see in that fund, we started the year with 1.5 million. We added 141,000. We took out 900,000, and that fund has shrunk. But some of the other funds, so recreation and reserve at the top, received money with no withdrawals. And so when you look at the bottom line, which is what we're seeing in the balance sheet, it looks like nothing changed, but in actual fact, we did draw down on those infrastructure contributions more than we had done previously.
Yeah.
I think you're actually looking at last year.
Is that last year? So, oh, you are. That is last year.
Yeah.
Same thing.
But effectively,
You can see the balance has dropped from 6.2 to 4.5, 5.4.
the big withdrawal from the roading contribution fund though was for Norman Ed, wasn't
Yes,
it?
that's exactly right.
And I'm sorry, I was away the week. There was a decision by council with regards to money being spent on the park. That we won't, that none of that figure has been moved down at this point. It's just been.
We haven't
approved to
spent
spend.
any money.
Yeah.
So we're developing the plan.
Yeah.
And we will come back and that spend will come out of that top line recreation and
Yeah.
reserve accounts. So that 2.1 million is where it will be funded from.
That'll make a big difference to the overall pot of reserves then.
Yeah, so that'll drop by 2 million, and we'll probably continue to lean on roading contribution, infrastructure contributions funds, instead of borrowing, because it's a whole lot better for the ratepayer to draw down on special reserves if we've got the money there.
Another question vaguely relates to reserves, and that's around our internal loans. So we've got about $7 million we've linked to ourselves. Presumably that's come from the reserves on the balance sheet, whether it's the special reserves or the general reserves. So a lot of those reserves we're not actually holding in cash. We've spent it on bonds.
Correct. So perhaps we could park the numbers in the books type thing and just speak cash for a moment, because I think it makes it a whole lot easier to understand. When a property is subdivided and we receive contributions, we receive those contributions in cash. Now, there are some ways that we can get them in kind, but mostly they're in cash. So we hold that cash for these purposes. We're not allowed to spend it on salaries or whatever. It's only able to be spent on these purposes. So we ring fence that, hold it aside. Now, from a cash perspective, it doesn't really make a lot of sense to invest that in a term deposit and then go and borrow from LGFA to build our road or develop our wastewater pond. So we use the cash that we hold for these special reserves and general reserves to at first before we borrow. And that turns up and shows up in the books as internal borrowing.
Mhm.
For the accounting, we keep it all separate and it is all nice and neat. And Stephen's nodding politely, which is fantastic because
They're in the right
gives me
category.
a great deal of comfort that Stephen knows they're all in the same category. They're all nice and tidy. But from a cash perspective, we just prefer to maximise the cash that we've got before going and borrowing and paying additional interest, because the margin is not great on term deposits, as most people will know, and it's a whole lot better just to use that cash.
Looking ahead to when we move the water's assets and the debt, we'll actually get that paid back to us in cash, won't we, from the new entity?
Yeah, I'm not sure whether it'll all come up as one lump sum and we'll have this enormous party, because we got all this money back, which would be lovely. But I think what will happen is as the debt comes to maturity, it will mature and be transferred to the new entity with the new debt. So it will be a period of time that it will wind off our books and wind on to the water entity.
But including those internal ones.
Yeah.
Yes,
Because
yes.
they are physically documented.
So in the water services delivery plan that we've submitted to the DIA, the debt number is split into 3 categories. It's external debt, internal debt, and total debt.
I assume that the water service entity would be funding the interest, otherwise the ratepayers could be funding the interest of.
Well, the activity funds the interest. So if there is an internal loan,
Yeah, but no, what I'm saying in terms of the water services, if the loan, if the revenue is now being treated by.
oh yes,
Yes.
yes. So from the date that we transfer and they go live, they will be responsible. The water services entity will be responsible for all debt, including internal debt and all of the interest costs associated with it.
Any further?
So could I just pick up some of our non-financial metrics if there's no more questions? One of the things that I noticed when going through was there's a change in our water loss. So we've previously had quite a low water loss metric number, sort of 16% or below. And this year that's spiked. And of course, we did our homework as to why is that the case. And speaking to Lawrence and the team, we also note we had quite a big outage on High Street, and that occurred in May this year. And with a small water network like ours, when we have a relatively large outage like that, particularly with a water main, we do end up with a spike in our water loss. I just wanted to highlight that previously we hadn't had such significant outages as that at such pressure. We did investigate why that was the case.
And just following on from that, you mentioned, I think it was last week, that there'd been a change in the calculation as well in how we were measuring the water losses, if it was across the year divided by that kind of thing. Do we know what the actual figure was with the new maths that you've applied this year, the 27%? What would that 13% have looked like? Are we heading in the right direction, or it was just a bad year?
I'm going to,
That's fine.
if I'm permitted, can I lean over and talk to our team?
The losses improved because when we brought in across the network often get the data, get the side back. So in past years, we won't have read as often, or they were on manual. So the actual data is there to say how it or did change. Just trying to think about it, because the water meters, the smart water meters were rolled out just after COVID, because it all got late that side of it. So, and as more and more houses come on and change on it, you can improve the number on it. So that's why this year's quite good. But out there, we've got regular meetings in, so we can actually really be able to focus on spot. It's like, oh, that's a spike there. And we started rolling in the rolling average,
the average across the site, but just go good site.
Could I rephrase,
Good
David?
question.
I think Councillor Ayling is asking, the number that we're reporting this year, is the calculation for prior year identical to the calculation for this year? And if so, what would that number be? Is
Thank you.
is that your question?
Yeah, if we're comparing apples with apples, what did it look like last year? We said it was 13.
Yeah.
But that wasn't the same maths we've used this year.
No.
So what was the 13?
Comparing what the figure that I used last year in terms of the calculation was 13 last year, and it was 21% when I used the same spreadsheet for this year.
Okay.
I had more assumptions built into that in terms of reviewing fire call-outs, flushing that we do on the mains, flushing hydrants and that, rather than just a base water balance in terms of how much we've measured from the water meters compared to how much has been treated.
Would it help
Mhm.
to use this year's measure calculation and provide a note on what last year would have been if we'd have used the same measurement last year? I wonder if that would add richness to the numbers that we're reporting. Is that possible?
It's quite a confusing difference for people who look at that and go, what's happened this time? Have they really dropped the ball? And if we haven't really dropped the ball, it'd be nice to give evidence of that. And if there has just been a main leak that really spiked things, that would also be helpful to know as well, because it just 13 to 27, that was like one of our things that we celebrated, that was. So it'd be really nice to know a little bit more behind those two numbers.
Is that possible? Just to take,
Yes.
okay. All right, let's do that and see if we could add at least a lot more commentary around what's changed and why.
So the bulk water meters that we have got operating now, would they have picked up that that major leak, David, when it was? So we could probably can we go back and work out that bulk water meter spike at that time?
Yes. Yeah, it shows up on the flow into the network.
Yeah.
It's a big spike on the side, but the difference there is really on the reading meters. We do have an element of error that will always go in because the meters are only read once a month.
Yes.
So there's worked out full mass required to work out what the plus or minus percentage should be on the side of it. It's quite hard. That one's quite hard enough to get my old maths. It's that's on that. But because the meter readings are done on a particular date in the month, it doesn't quite match the day photo that we get them. Which is why we take an average, just to be sure of see, try and work out how much is the impact I've had. Therefore, average. I just sort of took the commentary. You get one leak which won't be covered, which will be a litre a second because of the size of the network. That'll increase your water loss by 10-20%. So we've got a number of rural properties, and because you don't get the people driving past or walking past, is usually you don't really pick it up. Like we've had one up on Chester Road, which I think has probably been there for quite a while, which hasn't been picked up.
That's one on the transfer station that got picked up not long ago.
Yes, yeah. Again, that was underneath a whole lot of pine trees and that, so could quite easily been there for quite a while, which we only picked it up until December, so it would have been at least sort of 6 months.
Trees wouldn't have minded. Yeah. Can we look at some more of the non-financial metrics?
This is yep, now's the time.
I just don't know, would I do it now or do we do it at the meeting at 1? But some other ones that I looked at was page 53, streetlight faults. The goal was 80% and we got 33%. Now, I know that streetlights are something that people really, really notice, but it's not always something that we have total control over. So can you talk about that and why the figure is quite near our goal?
Absolutely. So we're taking that one on the chin for our network provider. So where the Streetlight has got a bulb issue, or there is a failure in the actual structure of the streetlight, then that's us. Where an entire street is out, that's the network provider. So but that is counted in our measure. So we go to our electricity network provider and say, hey, look, we think there's a fuse out somewhere because the entire street's out, and none of the bulbs are blown. So it's up to them to respond to that and get the streetlights back up and running. And unfortunately, when they don't respond, there's not a lot we can do other than continue to ask when they will pick up with the phone. But yeah, so.
The actual process is slightly out of our control when there's a street with lights. You have to go to the power provider, then they're the only ones that are allowed to report the fault to the lines company. So this chain of events does lead to delays, which has this impact.
Yeah.
So question on that, right? When we're doing the measurement, yes, streetlight is out. Is that the actual right measure though? It's not a streetlight fault. It's actually a
Power outage.
power outage.
And I know where you're going, and
Yeah.
our customer has lost service because there is no lighting in the street.
Yeah.
And I think that's the measure. Whether it's us, whether it's our electricity provider or the lines company,
They don't care.
they don't care. It's a loss of service because there is no light in the street. So we do have to take that one on the chin and say, actually, we'll own it, because it's up to us to raise it with the electricity supplier and then keep on their back. So I know where you're going, but I consider it a loss of service.
If we have a traffic accident, it could be to carry it. Delays.
Yeah.
Customers won't see that. So we get our faces quite on this.
Yeah.
I mean, if the other one where the lights just stuck on, they're not,
Yeah.
and that's also a street traffic. They also.
I'll give you an example on the high street. I had the accident with a shop that was taking out, there was a link across that shop. Lights on the other side of the veranda and the side of the street were interacting. It took months to get that fixed.
Yeah.
Half of the high street now hasn't got lighting on it anyway, on where those shops have been removed.
Look at that solar powered street lights, only go during the day. We need them.
It's good for the dark sky reserve.
Yeah, well done, Luke. Very appropriate.
The other thing is some of the street lighting is supplied from a meter within a building. So it's then it's involved, but the public will see the power is coming from within the
Another one.
Yeah.
Nice. I've got page 70, I think it says here, wastewater fault attendance was another not achieved. 60-minute was the goal and it was over 2 hours. What is the main cause of that? Is it we just don't have the people on the ground to do it quicker, or is there a notification issue?
Can I, I'll turn to Lawrence and the team. I also know there was one of the metrics that we was just moving in the last couple of, before we published the report, and I'm not sure if this was the one, 2 hours 47 to 2 hours 53, David. Oh, it was potable water. Apologies. I'll ask Lawrence to help an answer on this one.
I think that is our reporting methods. We're not very good at closing off jobs. So I think it'll be in the magic, you could take somebody, go in and close it off, and it's usually,
It's been done, but it hasn't been ticked on the computer.
and it'll be potentially a couple of days later where somebody goes, oh, we've done that, and just close it off then
Yeah.
without coming back saying, actually, we fixed it on 2 days ago at this time.
Mhm.
So yes, it is something that we can improve, and I think it's more our reporting more than.
Service delivery.
So one or two
Good.
jobs that
Yeah.
are left unclosed off 3 or 4 days, throws the whole thing out.
I mean, medium does.
Yeah.
Just for that, but yes.
And what you got? You're going well there, Grace, because I had the same.
Same ones.
Mine was, yeah.
Not the PDF, right?
No. I have to go back to the one that you sent me earlier, which you might have cleared. Well, transferred them last night.
That's what Grace was looking.
Yep.
On page 143, things that have happened since the balance date, Belvedere Hall, that sort of implies that we've given it to the government.
Great spot.
Yeah, yeah.
Because that was news to us as well.
Okay. So have we?
It appears so.
Interesting.
Yes, we were.
Sell it.
Did they get the land?
We were very surprised with the notice that came through on Belvedere Hall, and that came through just as we were preparing the final notes to the accounts. And so what appears to have happened is the revoking of the reserve status of Belvedere Hall has meant that it's now surplus Crown land, and it's been taken back by the Crown to dispose of.
Oh,
So they put it on the market, 'cause it's on the market now.
Have
Yes.
on trading.
Yeah.
Yes, so it's Crown land. So yes, we had the same face that you had. That was not our expectation. We thought the Crown would remove the status and council would dispose of the land, and it appears.
Yoink.
Yeah.
And I don't see iwi leaping to the forward to take that.
Well, the adjoining landowner.
Surplus land.
Yeah, the adjoining landowner was very, very interested in acquiring the site, so I don't see there being an issue with selling it. But we were just shocked that a building that we had that we thought we were going to sell, we suddenly no longer owned.
Because I think the land was vested in the council from the Crown.
Education department years and years and years ago. Yeah.
Yes. So they just vested it back, basically.
But yes.
yeah, just on those post-balance sheet that we talked, is people from EU okay with risk pool? Understand what's happening with risk pool? That's an ongoing saga. Which may or may not get resolved quickly.
It could go on for years.
Yes.
Yeah.
And I had another question here that I'd missed past, page 59, service request acknowledged. I wonder if you could talk, it was one of the things I remember you mentioning to us a while ago that you wanted to have a better process for how the service requests are done. I'm just wondering if you can talk about what that might look like going forward, because it said that it was 39% acknowledged within the first 24 hours.
Yes. Can I just, but Jerry, is this something that you'd like to comment? I'm happy to answer the question.
In response to quite a few of the measures, we are putting a lot more focus on customer service function and which incorporates the service request system as a whole. So we were in the past we've been quite piecemeal or disjointed about how we're managing the service request system from when it comes over the phone through the front door to the delivery, and as Laura said about closing off some of those that gives us the actual stats accurately. So we've appointed Sheree Dewberry as team lead of customer service, and it's one of your primary functions that should take ownership of the service system. And so we're actually from entry to exit, we're managing the process really well. It also incorporates complaints as well. So like with measuring space.
Awesome. And is that metric included? So the walk through the doors or someone who rings on the phone, that's in the same collection as the people who do the website fill out form sort of thing?
In some of it, it's disjointed. Basically, if someone's telephone or voice ends up at the other end,
Yeah.
you have some gaps.
Is the wording in that metric just acknowledging it?
Yeah, which I'd always thought couldn't be a bounce back, but that's,
Well, yeah, and because if you're in person or on the phone, you're acknowledging it
Mm.
then and there, right?
yeah.
That's standard of the
Yeah.
phone seeming that.
Yeah.
It's the
Right, it's moved
Okay,
into
so it's
the
not
right
that
place.
first step, it's the
Yeah.
second step. Okay.
and it does depend on them filling out that they spoke to people. It's just-
Yeah.
That's what I'm saying. It doesn't happen how well somebody fills out.
Yeah.
Chief, how do you want to deal with, I've got a whole lot of semantics, but doesn't quite agree to that one, right?
Philip, Stephen,
Yeah,
Stephen,
yeah.
Philip.
Yeah, I thought that might be the case, right? There's, there was, sorry.
Yeah, there's
I
always.
don't want to talk about it in the meeting, right?
Yeah. The
But one,
detail of the notes, I think, is really critical.
yeah, but one of the interesting things that I noted, right, is we've got in page 34 of the report, 59 of the report, page 34 of the annual report. We've got some side comments about not met relating, and it's sort of, you got to skew your head to actually read it, right? It's on here, right? It's there,
Oh, okay.
right?
That's format, yeah.
Yeah, formatting,
Fix that.
right? I mean, I've got a few others like that as well. Where
Yep.
and the other one is we talk about the budget as in the note, but it was an LTP. I know technically year one of the LTP technically is an annual plan, but we make reference to the LTP through the rest of the document as well. So,
Okay. So we'll
got
happy to
Okay.
take feedback on those. It's the sort of, those are the sorts of things that are really important. As Councillor Dale found, we really didn't just grade 700 metres of roading. We graded significantly more, and it's really important we pick up those very small typos because they make a material difference to the report.
the other thing, since we're in workshop mode, has audit started?
Yeah, so audits were due to start this week. And we've got one auditor on site, one auditor who is working remotely, and the third auditor, I think, they've turned up today. So, all right. So, third auditor is now on site today. So, we expect them to be here for between 2 and 3 weeks, and then they will go away and complete their work off-site. The biggest piece of work for audit this year has been, as Stephen pointed out, the revaluations of our assets.
Yep.
So we undertook those revaluations first, noting that that was the time critical piece and the most complicated piece. And they went through and were completed by the end of July, and audit completed their review by them on the end of July. As far as we are concerned, the heavy lifting has been completed, and it is now just a completion of the remainder, and they'll probably have a focus on those non-compliances or those emphasis of matter from last year around the report, etc. But yeah, the heavy lifting's been done. The auditors are now on site.
The other question will be over our managed fund and other, right?
So two things have happened with that that matter of emphasis or emphasis matter, whatever they call it. The first was the investment committee reconsidered the investment and reconfirmed that investment. And then the investment committee made a minor change to the terms of reference, which included direct investments. So that's tidied up the paperwork and the committee and all of that kind of thing.
Yeah.
And then we asked PricewaterhouseCoopers to do a piece of work looking at the investment So for those coming up to speed on the investment, the issue is this time warp of our audit being in June and the investment audit occurring later in the year. I think it's December. And there's neither auditor are prepared to take the previous year's results if it's more than 6 months old. So we're in this time loop of no auditor being prepared to sign off the previous auditor's work because it's over than 6 months old. So and it's an additional complication for us as a small council. Other councils do hold this investment, but they are considered a small. The holding's not material. So whereas in our balance sheet, the investment of $1 million is considered material by our auditors because we're a smaller council. So we've got a time loop, we've got a materiality issue. What we've done this year, again, we've talked to the investment committee, thank you, Chair, for that, to resolve the issues around the investment committee. And then we've asked PricewaterhouseCoopers to do a piece of work that's looked backwards over time from Castle Rock's interim results versus their audited final results to see if there has been material differences between those two, and over time can we gain comfort from the fact that they are actually much more aligned than people tend to think, or the worst case scenario, and so we can rely on the interim results for our final audit. So that's what we're proposing to do. We can't see that issue disappearing until either it's not material in our books or to accept the fact that we are relying on interim results with a degree of risk, but given the history and hopefully the support from PricewaterhouseCoopers is relatively small.
Yeah, and we're still discussing that with Castle Rock as well. Okay, as late as yesterday. So, yeah. So we've got our numbers in the account. So it's just a case of being able to justify those from the auditor's point of view. But yeah, that issue may or may not go away ultimately. That is still a bit of a flag stage.
I have one other critical issue on page 112. You spelled my name wrong.
Oh, really?
Just done the elected representatives and remuneration.
Oh, we did too.
It's right everywhere else.
I apologise for that.
Best thing I look for.
And I just had two other small detail things on the page with all the staff. I think it was a really good addition, putting that in. As a positive that I haven't mentioned, the whole report was great to read. It looks fantastic. Some of those,
thank you, Sarah.
Those initial pages are just, riveting. And then you get like the spreadsheets, but it really is interesting. And I think one of the particular one of note was that it shows that 80-something% of our business is funding core infrastructure. And I think that's such a good takeaway to have early in the report. But I just noted you under the Jeff Hamilton Chief Executive, it says insert qualifications. You might want something. You might want something to pick something interesting.
Can boil an egg without
burning it.
Burning it, yeah.
Yes. And it doesn't mention that Johannes has left, and I wonder if we should, since we've mentioned it in Karen's blurb there.
Yes. Given that happened just yesterday.
Yeah.
It will. It's happened since.
Yeah. Well, when is this date? Is this
June? So this is the end of June.
Yeah. So I guess he hadn't resigned at that point. It doesn't need to be listed.
Yeah, so this is a challenge with the annual report. So I was at a council meeting yesterday, where they had an interim chief executive up until the 1st of July, and the new chief executive started on the 2nd of July. Yeah, so so on the staff as of 30th of June was one chief executive interim. And then who's signing all the reports is the new chief executive. So yes, these things are sent to try us.
Yeah.
Any questions? All good?
I've got one question.
Yeah. Thanks, Lee.
Page 21 of the annual report, so page 52. There's some commentary that says rural ratepayers see a greater share go to roading and community facilities. And I wonder whether some people read that as rural ratepayers pay more for their roads than our urban dwellers, which is incorrect.
Let's stop it.
Page 21.
Page 52 of the whole report. Next to that pie-ish chart.
It's a pie-ish chart.
It's got a hole in the middle.
Like it's open. Yeah.
So it's still a pie chart.
I just wonder whether it could be clearer, because if I was reading it without knowing what I know, I would think that rural ratepayers pay more for roads.
I will talk with Sarah. So I'm not great with semantics. Sarah's so much better with words and writing, so we will clarify. But yes, I take your point, Councillor Owen, we thought it was really important to talk about how much we do spend on infrastructure. And then, of course, the accountant and me went 82 plus 39. That's not 100.
Yeah.
You know, not meant to be, but very quickly.
Any more questions? I think we're done.
I think we're done.
I think we're done. We'll save all
I think we're done.
Well,
As,
so if I could wrap up, I'd like to say a huge thanks to the team, Sarah, Jerry, the finance team, Steve Watson from PricewaterhouseCoopers, that have got us to this point. I know the remainder of the team have been involved in a whole lot of non-financial reporting metrics, which also can drive a great deal of frustration and work. But I just wanted to say thank you to everyone for pulling this together. I think it's a great annual report. I'm very happy to be in this place. I think we're going to have a very successful audit, and it'll be brought to the new council in the new triennium towards the end of this month.
So I'm just going to close off the just those. So those adjustments, so how will we deal with those when it comes to the meeting later on the day? Will you have them wrapped up as a summary, or how will we speak to that? Because that's where the decision actually has to be made. This is a workshop.
Yeah, so I think we will just note there has been some adjustments suggested or some recommendations made, and the report is still in draft at this stage. It's got to go through audit, and we anticipate audit will also have some feedback on it. So this it will have to go through that process to be changed.
Yeah, because if you look at the resolution.
Yes, I see that. Yeah,
All right.
Yeah, it's adjustments and
As
approved. Yeah, I just wanted a clarification around that, because they're all good recommendations, and so that is all they can be from this point. But then picked up and brought in at a later stage. So that part of the resolution is the catch-all, I guess. Just want to add to your comments, Jeff, as we close off, noting that you've had transitional staff and there have been changes along the way, and noting also that the council struggled at times with the annual report, and we went through some bumps, and there were challenges along the way. But where we've landed, I think it's a very good place to be. And particularly when I'm mindful of utterances that come out of the shed in Wellington, where there is a strong focus now on councils adhering to core business and focusing on things that are infrastructure and things that matter. The challenges and questions around councils throwing things away spuriously on what is often labelled as vanity projects. This is a good way to conclude this triennium. And I think for those who stood on that basis in the last election, it's got to be a very comforting place to have finally landed for everyone on council. And I think there's been learnings on both sides of the table, both from elected representatives and from management, noting that there have been transitions, noting that there's been personnel changes, noting that you've had to do all of this with that all in the backdrop. Good effort, and thank you for those that have offered up questions today. Thank you for doing that. Let's count on you. That's what gives this council strength. I hope it's a strength that gets to retain. That's all I'll say. Thank you very much. So thank you to everybody in the back row.
Are the team not joining us for the meeting? Who's joining us? Stephen.
Stephen will join us for the meeting in.
Yeah, okay, cool.
Risk insurance.
Risk insurance, yeah, yeah, right. Yeah. All right, we'll see you back at one. By the way, that
Just so-
that clock is wrong.
Just so you know, yeah, well, something's allowed to be wrong today. Just so you know that, we have, there have been people invited to something, courtesy, they have no speaking.
So, good.
Okay.
Very good. Thank you, everybody.
Welcome.